All right, so welcome to the webinar. Today, this webinar is entitled the GuruFocus Chart Tutorial. And as I mentioned, what we're going to do is be reviewing the proprietary chart system within GuruFocus.com, show you some of its benefits and features, how you can use those for various investment techniques, and how you can maybe unlock some of the abilities you didn't even know it was capable of. So, if you have not yet used these before, you're definitely going to after today's webinar. Really quickly, to find them, all you have to do from the home page or from any page on GuruFocus, at the top you'll notice that there is a menu bar on every page. And so what we're going to be doing is hovering over this Screeners and Tools area. And when you hover over that, this giant drop-down menu comes up, and in the middle section, about 3 options down, is Interactive Charts, and that's going to take you directly to the GuruFocus chart platform. The other way to do it is from an individual stock, and we'll go over that as well. So let me show you what this looks like live, and here it is from the home page once again. So hover over Screeners and Tools and click on Interactive Charts. If, for instance, let's say you were already on a stock, say you're on General Motors, for instance, and you're on the summary page, at any time you can reach that chart right here in the middle of that interactive chart heading. Okay, so this is going to work for any equity, and I'll also show you how to do it over some broad economic indicators as well. So let's start with, actually let's go back to Walmart. It's going to be a nice stock with lots of history and pretty stable firm. So we can kind of begin to explore some of the features of this. Now, at first sight, it's going to take you to a traditional stock chart, right? It's going to plot time across the bottom, price on the vertical axis, a traditional stock price chart that we're all used to seeing. Now across the top here, we've got a full history. You can see this goes back all the way to 1990. So first of all, you got a lot of data for you here. It's 25 years of time and price data for the stock. You can select the top here to bring it down to a 10-year or a 5-year or a 1-year, even really short term into like a 3-month time period if you choose to. But you do have a lot of time options there. In addition, you've got this search box here where you can manually input certain date ranges that you want to see. So if you're going back and doing former research, if you want to go back and see what this thing looked like from, say, 2005 to 2013, you can do that as well. So that's kind of how you're going to manipulate these, just for the basics. And then once you've got here, we're going to begin to apply these different series over top of this chart or in place of it. Now on the left side is where these are all listed. They're grouped in 6 different groups. So we've got, by default, it's going to show you the most popular ones, the company revenue, the net income, the historical PE ratio, and the list kind of is endless down through there. There are also groups such as valuation and quality, income statement, the balance sheet, cash flow statement. If you want to project specific fundamental data, it's kind of grouped to make it easier for you to navigate through. And then finally, there are large economic indicators as well. We'll cover that toward the end, but let's start with some of the most popular ones. So to begin, let's say that we're looking at Walmart. We just want to see its revenue history. Okay, so what this is doing, it's plotting the quarterly revenue figures for Walmart over the last 10 years. We can kind of begin to see a trend. It's obviously not surprising with a stock like this. In addition, let's say we want to look at the net income. How profitable is this company? Well, it doesn't look like we're seeing much here, right? Because compared to revenue, we know that Walmart is known for its thin margins. But if we take the revenue off and take the price off, then we get a much clearer image of that net income over the last 10 years. And in fact, we can even go back, looks like we got net income revenue all the way back to 1996. So almost 20 full years of data here as well. Now some of the others, market cap, in other words, the total market size of that company, stock price times number of shares, and et cetera. The interesting thing is, I think, some of the ratios, right? So one thing I like to do is overlay the PE ratio with the price. And what that's going to show you, in a case like Walmart, we're going back really far from when it was a high volume growth, an explosive growth stock trading at higher multiples versus now it's a much more stable company. But if we look at, let's switch this to, say, Let's look at Ford, for instance. So what this is going to do is allow us to see the price, which you see here is going to be green, and the P/E ratio here in blue. And what it allows us to do is kind of see when there are opportune times to buy this stock. Now, we see some gaps in this chart because the automaker, when it is negative, there is no P/E ratio, right? It's going to be a negative or an infinite P/E ratio. If we look at, say, a General Electric, on the other hand, they're a little more consistently profitable than maybe an automaker. And what we see here is that when the price, when the P/E ratio represented here in blue is the lowest, these have been some of the more opportune times to purchase this stock. Okay, so we're seeing here we had a chance to get the thing down to 17s back in 03. You had a P/E ratio of 6, 7, 5.5, and on these dips, I mean, this one the stock is very much following, in a sense, the P/E ratio, but from a long-term perspective, what it allows you to do is kind of see when there were some, how it has performed buying it at lower multiples versus buying it at higher multiples. Now, someone asked about the PEG ratio. I think, let's see. You can also search these series. If you don't want to go through them all, right up here at the left, you see this little magnifying glass icon. If you just kind of begin to type, it will kind of populate those. Now, the PEG ratio is one that is not currently available on the charts, but I believe it should be soon. So let's look at a couple of other examples of kind of some ways to use this. So the big three when you're looking at value investment, right, is what? Price to earnings, price to book, and if you're looking at especially like a retailer, price to sales, right? So let's take a look at overlaying several of these and removing the price. Again, sometimes you put too much on there, it's kind of difficult to see because the figures in this vertical axis are excuse me, so far off. But we can look at price to book ratio, giving a historical view of how many times book value that stock is traded at and what kind of values you're getting and how opportune those opportunities are. Here we see when the lowest this has been, General Electric once traded at 1 time book back here in February of 09 at the market low, and of course that would have been one of the best possible times to buy that stock. You'd be sitting on a several 100% return. Now, one of the more interactive features that I like is comparing this, seeing a hypothetical price at certain levels. So, for instance, if we're looking at GE, and let's say we're in the 10-year financials, okay, and we're going back here doing some research into the valuation ratios, and we're looking at this line here, right? We're looking at where the P/E ratio has been each year over the last 10 years. So we kind of get an idea of where the stock traded, what the multiples are. And we're seeing that this stock is traded anywhere from a low of about 9.5 times earnings to a high of about 22.5 or so, right, if we really want to dig into this. It's kind of tough to see some of these figures, but because the numbers are so small. So let's say, we're valuing, we want to do kind of a very Graham-ish type analysis on this. So we want to pay no more than 15 times earnings on this stock. What you can do is, this is kind of similar to the Peter Lynch line. See this right here where it says price at PE equals? By default it's 15, but you can set it at any number you want. So just give it a fair value at 15 times earnings. What this is going to do is plot a hypothetical line for what the price of the stock will be at a PE of 15 or at 15 times earnings. So if you think GE is a value under 15 and it's overpriced above 15, well, then your opportunities to buy this stock are any time it trades below this red line. We had a nice opportunity here in 2011. It's come pretty close here recently. And one of the newer editions of GuruFocus is here in the yellow. It actually puts out the analyst expectations of where they expect the earnings to be, and you'll see what that is going to dictate into a price as well. So Henry in here asks, can you please explain price to book and when it's appropriate to use it? Henry, it's a fundamental ratio that measures how much book value you get for every dollar of the stock. Okay, so the book value of a company is going to be essentially its net worth, right? The cash it has on hand, its inventory, property, plant, equipment, etc., minus all of its debts, its liabilities. So in theory, it is if they stopped doing business today, fired everyone, sold everything off, this is what it's worth on paper without generating future earnings. So some investors like a Walter Schloss and even Buffett uses it a lot. They look at price to book because they figure it's a really nice safety net that if you buy a company trading near its book value, then even if they don't earn much going forward, the stock is still on paper worth at least that book value. So that's why people tend to like it. Again, price to book is a big one. Price to earnings, another one. Price to sales, and additional to that. And just to clarify, I had a question on here. The book value is the full book value, not tangible book. That's correct. Now, so this is the rest of these are pretty much self-explanatory. I mean, again, if you want to see this thing at a you know, let's say you don't want to pay more than 2 times book for it. Well, you put it out. Where's the figurative price at twice book? And you see when you get well above that, the stock suffered some pretty heavy losses. But by buying in this opportunity area below that 2 times book and really at about the price it is today, you've got a much better safety net. So in a very basic sense, if you've got some parameters you want to stick to, you don't want to pay more than 15 times earnings, you don't want to pay more than twice book, you dictate these lines onto the chart, and when you see the stock below those 2 theoretical barriers, then it's quote unquote a safe time or an opportune time to buy that security. David asked, is there a filter to see listed companies trading below book value? Yeah, absolutely there is, David. It's within the site. We can cover that in another area, or I can ask Charlie to cover that later. But basically, you're going to go up here and use the screener. And you can see there's several screen lists here. Historically low price to book near that company's lows. Or you can do the Ben Graham net strategy. I mean, they're trading below their tangible book value. Now, Henry's asked a really good question here. He said, forward-looking earnings, the yellow section of the chart, appears to be key to determine if price is below 15 times earnings because it's a good time to buy for versus earnings forecast going forward. And yes, you're totally right, Henry. You know, most of Wall Street, when you look at the analysts and they're quoting securities and they're quoting stocks on earnings, they often mention the phrase forward earnings, right? So it's trading at, 15 times forward earnings. And what that means is next year's expectation based on these analyst estimates of what that company will earn next year. So let's look at a really heavily followed stock. Let's look at Apple. And what we see here, let's get this price to book one off there. Let's just focus on the earnings. That's really what matters with a stock like Apple. And let's just go down to a 5-year chart. So again, this is where it's really powerful, right? I mean, what would you say an Apple caliber stock is valued at? I mean, if we go back, 10 years, this is a strange one, really 20 years. That's really traded pretty. I mean, it never really got overinflated, which is surprising, as it is the largest company in the world. But is it a growth stock? Is it more of a staple stock? I mean, now it's become kind of a Dow 30 company. So what are you willing to pay for Apple? What are you willing to pay for that growth? 15 times earnings, 18 times earnings, whatever that figure is, you can simply plug it in here, check the box, and it will put out that theoretical price of what the stock will be at this multiple of earnings if the expectations going forward are met. So even at 15 times earnings, which we can all agree is fair, especially when the S&P is trading at 21, 22 times earnings, something around that, this is what the estimates look like for Apple. So it's really, really a powerful tool, because what it does is integrate both the visual aspect of looking at a theoretical price at earnings and also incorporating, in this case, 2.5 years really, of analyst expectations for those earnings. So if you don't want to look at it so complex, but we can just look at earnings per share. and this is what analysts think they will be. Let's see, go back even further to 10 years. So the red line here is what they have been, right? They were earning $2 a share, 4, 6, etc., and they're forecasting $10.80 a share by mid-2017, right? So, look, if we buy a stock this year, we're not planning on selling it in a month. We want something that's going to earn us profits over the next couple of years, and the way to do that is forecasting, right? Is it guaranteed it's what it's going to be? No, of course not. We know we have to take a leap of faith in the investment community, but we want to have a reasonable expectation of what we can see that becoming, and that's one area where value investors tend to slip up is they forget about the future, and they're so focused on what the multiples are based on today's prices that they don't take enough time to look forward into what things will be in the future, and that's what's going to dictate what happens to that stock movement and what kind of price we see going forward. So, look, we've had a huge run up in Apple in the last 12 months, right? So, when we look at it at 15 times earnings, it really hasn't strayed too far. Okay, the light baby blue lines are priced at 15. It was a great opportunity here in 13. It's a little bit above that area now, but still not wildly overpriced. So even buying it slightly above that level, even at just 15 times earnings, over the next 2 years, we should see that stock hit the 160s, which is going to represent a movement from 126, call it, to 163. So we're looking at $38 a share. So about a 30% return in 2 years. So really not terrible for a stock that's already at all-time highs and approaching $1 trillion market cap. So Henry asked the price comparison on earnings per share versus P. Yeah, it's just two different ways of looking at it, Henry. I mean, the earnings per share gives you the exact figure of how much they're expected to earn per share, and this is a theoretical multiple. So look, there's some companies we're willing to pay more for, right? I mean, if we look at, let's say, a John Deere, this is a very stable, kind of boring company. They're not experiencing phenomenal growth. The price has been very stagnant for the last several years. We've seen here kind of bracket between this $80 and $100 a share level. So this is a company, and let's look at the earnings just to give you an idea of that. So not really explosive growth, right? I mean, it stayed right in here, $7, $8 per share. This is not Snapchat, right? This is not Google. This is not a monster that is growing at 10, 15, 20% a year. So we don't want to pay 20 times earnings for a John Deere type of company, right? And we project that line. Obviously, no one else does either. But what is it worth? Is it worth 15? Is it worth 8? Is it worth 10 times earnings? That's going to be up to you and based on your investment discipline. But this is a really nice way to project a line and say, okay, it's either above what I think it's worth or it's below what I'm willing to pay for that stock. And we see why now Deere has really not done much. Because we have this yellow section, because we have these analyst expectations, we see that they're projecting earnings to shrink going forward. And that's why there's a lot of kind of negative connotation around this stock. And we just haven't seen the price grow. People are holding Deere for the dividend, not for appreciation recently. Yeah, so I got a question about the short interest. Let's definitely take a look at that. A lot of people like to dive a little bit deeper. And what short interest shows you is it is the percentage of the outstanding shares that are held short. So why does this matter to you? Well, a couple of reasons. One, let's look at a company like Deere. If a substantial percentage of those shares are held short, the first thing you think is, am I missing something, right? Is there big news out there? Is everyone think these earnings are going to crash? Why is everyone short this stock if I think it's a good buy? The second thing is the potential for what's known as a short squeeze, right? So a short squeeze is what happens. Most of us are long stocks, right? We're buying a stock to begin the transaction or selling it to exit the transaction. But some people are short sellers, so they do the exact opposite. They're betting on companies to fail, so they start by borrowing shares and selling it, and then they buy the stock to complete the transaction. So if they sold this at 95 and they bought it at 50, they profit $35 a share. So when they're all short, they have to eventually buy back the stock to close out their position. So if you get a stock, for instance, what's a heavily shorted stock? Let's take a look at EBIX here. All right, this is one of Charlie and my favorites here. This is EBIX, EBIX. It's a small cap company. It's not a big hitter. It's not a Fortune 500, but it was trading, what was it? It was less than book, right, Charlie? I mean, if we look at the price to book ratio of this thing, let's see. Yeah, I mean, down here we had, right around book value this thing was trading. So we began buying up shares here in kind of the $10, $11, $12 range. And a lot of people were short this stock. And I'll show you that here with the short interest. I apologize, this isn't very fluid, guys. I'm just trying to put everything out there for you. When we overlay the short interest, and I'll take the price off so you can see it, trying to change the colors. Green is the short interest, so it's the percentage of shares held short. And when this stock was crashing, see it here in 2013 where it got all the way down to $10 a share, $11, $12 a share, where it stayed for almost a year, 50%, really up to 55% of the shares were held short. So what does that mean? If everyone bought the stock and it doubled, a lot of people are going to sell, right? If everyone shorts the stock and it goes from 40 bucks it goes from $16 down to 15 or somewhere in there, everyone is going to cover that short. And when they cover, they all have to buy to end their transaction. All that buying pressure, especially on a small cap, thinly traded company like EBIX, it results in a push higher in the stock price. And that's what's happened here as it's gone from $9.50. Notice over the same time where short interest went from 55% down to 35%, the stock went from the $11 range up to the $15, $16, $17 range. And it's continued to push higher ever since then. So in lumber liquidators, as Sean pointed out, here's another one. We'll look at that. It's going to be even more short interest, especially as of late. And yes, Manan, sorry I missed your question. Ralph, the analyst estimates do come from Bloomberg. That's correct. It is a consensus estimate from the Bloomberg data terminal. So look at the short interest here from lumber liquidators. The price is in blue and the short interest is in red. And ever since that story came out, they started tanking this thing. The short interest has just spiked from 20% all the way to 50%. It's recently pulled back a little bit based on the most recent filing here, but huge, huge short interest. So people who were the bulls of lumber liquidators who see this as a buying opportunity, they have this as one positive working for them, that when these shorts have to cover their position, it will push the stock higher. Now, it's not saying because there's a bunch of shorts the stock has to go up. I mean, it could still go, if you look at like a Radio Shack, it can still go bankrupt and those shorts will win. They'll close out at 10 cents a share. But it is an interesting component to keep an eye on. Another one that comes up is Herbalife. This is the Ackman battle. That has been really exciting on Wall Street the last couple of years. But we look at the same thing with Herbalife here, right? I mean, when Ackman began building a short position, he was shorting every share he could, and we saw this build up. And then you see when that short interest dips here from 40 down to 30, at that same time the stock price went from $40 a share to $80 a share. So that short covering or short interest spiking is going to move the stock, especially on these smaller companies. And when you look at, especially the last couple of years here at Herbalife, it's almost inverse, these two areas. As short interest picks up, price goes down, and vice versa. So look, 62% of the shares of Herbalife are held short. When those get covered, if they do not find this company to be a fraud, and if it does not go bankrupt, you're going to see a big surge in the price of the stock. Now, Poke asks, how far in the future can the earnings be realistically projected? It's really a matter of opinion. I mean, these are not our projections. These are the professional opinions of the top analysts on Wall Street who are covering the stock, and then a consensus estimate of those. Look, some are wrong, but I would say based on the millions of dollars they put towards research and putting these numbers together, I mean, for larger companies, they're usually pretty close, right? If you're looking at Dow Chemical, you're looking at Procter & Gamble, they're going to be pretty close with their estimates. When you look at, a new tech startup, it's kind of anybody's guess. So Rod's asking about the price at median, price over sales, etc. So as we saw earlier, let me take the short interest off, and let's go back to, say, an Apple type of stock. So there's lots of good data there. So we looked at, doing a hypothetical PE range of, say, 15. We checked this box. You can also do price at the minimum PE, so the lowest earnings multiple it's ever been. We have to go all the way back to, I guess, even further in 09 to see where that is. And also price at the max PE, the highest earnings multiple it's ever been. Now, this is a pretty wide range, but for some companies, it can give you a pretty good band. Now, I don't know about the price to earnings, but price to sales and some others work pretty well. So there's the price of the max PE ratio, a theoretical price at the minimum PE, and also at kind of the median PE ratio of that company. One thing we like to look at are price to sales bands. So if we take, let's say, what's Bed Bath & Beyond? Is that right? Yeah. So let's look at, again, we got a lot of data on this one too, over 20 years. Let's look at the last 10 years. And what I want to see is the price to sales range of the stocks. Let's see where it would be at the max price to sales level it's been and the minimum price to sales level. And then what's the median level for that stock. So here, I mean, it's still pretty wide just because, again, with 09, it's kind of thrown some things off. The last 5 years, you see that's a lot tighter. And if we go to the last 3 years, it'll tighten up even more than that. But what it allows us to do is kind of see where this stock lies based on historical valuation. So let's look at this 5-year one. So the highest price to sales level we've seen up here, 1.862. The lowest is just over 1, and the median is about 1.42. So judging on price to sales alone, is Lumber Liquidators a good buy today based on the last 5 years or a bad buy? Again, just on this one indicator, to me it's a good buy, right? It's trading below its median. It's in the lower half of its average range. It's near the bottom of this channel. So to me, if you're looking at buying this stock based on that metric, it's a fair buy here. Now, if we look at something a little more inflated, for instance, let's look at Best Buy. We'll go to the same 5-year period. And you see Best Buy trading a little on the higher end, right? We've seen a nice run up in the stock the last couple of years, and it is traded generally between 9 and 62 is that full range. But the median is somewhere around $30 per share based on average price to sales multiples, and it's a little bit on the higher end. So if I'm looking for a long-term buy in a Best Buy based on this metric, I'd look for a pullback down, below the $30 range. So Scott, why would you use price to sales? Scott, some companies just tend to move more based on sales than others. I mean, we all know to follow earnings. We all follow book. I'm going to let you guys in on a little secret, okay? Let me show you something. How many of you guys trade Amazon or own Amazon? Anybody? And Michael, I haven't forgotten about you. I'm going to answer your question in just a moment. Let me give you the indicator. I say indicator, the metric that moves Amazon. If we look at the PE ratio of this stock, I mean, you might as well be looking at another language, right? I mean, it's been 50 down to 52, up to 260. It's negative. They're forecasting 100. I mean, this tells me nothing, right? When we look at the price to book ratio, there's no consistency there. They had no book. Now they're, I mean, they got just barely. I mean, yeah, 16 times appears at 4,000 times book. That doesn't help us. But the price to sales ratio does. That stays pretty tight between about 3 times sales and 1 time sales, right? So let's do our previous exercise. Let's look at the last, we'll say 10, maybe we need to go to 5. Let's look at the price at the max times price to sales and the minimum price to sales level over the last 5 years. Now look at the price to median. And now we've kind of got something, right? Amazon, as we see, trades pretty close to this median PE range of 2. The high side you can see here in the data in the top left corner of that chart. The max price of sales is traded in the last 5 years, 2.7. The low is 1.5. Amazon glues to 2 times sales. So if that's our level, we've identified this as kind of a fair metric that the price of Amazon tends to stick to. Here's what we can do. We'll go right over here to price at P over S, price to sales. We want to see the price of Amazon at 2 times sales. Now, that's all the way back to 1998. Does that look like a pretty good indication of when Amazon is a buy and when it might be overpriced? This stock is glued to sales. Why? Well, for one reason, if you dig through the filings of Amazon, they don't have much earnings. The reason is they spend it all. They put it all into research and development. 2013, I think they spent something like $8.5 billion on research and development. Don't quote me on that figure, but I think it's pretty close. People aren't buying this for the dividend. They're not buying it for the earning. They want the growth. They want it to continue to be the mammoth it is and eventually have a low price to earnings multiple and produce. So they're the only way to really value Amazon. There's not much booked. There's not a whole lot of earnings relative to stock price, but there are sales, and that's how it's tracked, and that's what moves the stock. And so what I did, I actually bought this stock at 300, not because I'm any kind of genius, but I know the blue line is well below the red line, right? It's just basic value investing. If we say, okay, at twice earnings, this thing should be worth around 375. It's down here trading the 290s. I know I can hold this, and it should soon come back to 2 times sales. In addition, we should see this line continue to grow going forward. And Rod asks, how is the median price to sales under valuation and quality section different? Rod, good question. It is not. Okay, so all the indicators are found in here. This top section we're in is just the most popular one. See that heading right there? So it's pulled some from each of these and put it up top here. I'm sorry, my mic was off. I apologize for that, guys. But what I was saying was answering the question on the sales versus earnings. Look, I'm not telling you that you know, we can assume these sales will keep going. I'm not going to make any predictions on this stock. Just that in the case of Amazon, that sales has been a far more valuable piece of data for us investors versus, you know, earnings or book value when it comes to a stock like this. Michael, you can also convert the prices to a log chart as well. A couple of options you've got in the top right of the chart here. One is embed. If you want to embed this image into a web page or a blog, it'll give you a code to do that. You can save a PNG image of this if you just want to keep that on your computer or put it somewhere. You can also do what's called an Excel export right here, and it'll drag all of this data into an Excel spreadsheet if you are a data miner and kind of like to do your own research. So let's look at the last couple of things here. Again, I don't want to go through each and every one of these because you can kind of do that on your own. I mean, you will spend an entire night digging through this. It's really, really interesting stuff. You can look at the insider ownership, institutional. We can go through, you know, Joel Greenblatt's earnings yield method. If we look at, let's say, let's look at AutoZone, for instance. So what we can do is kind of, if you're, you know, a student of Joel Greenblatt's method, we can pretty quickly get an idea of the earnings yield of this stock over time, and we see that as prices increased, that yield is dragged down, but it's still a fantastic yield based on what else you can get in the market, right? I mean, this is a stock, and we see why this thing has gone from $115 to $700 the last 6 years, because it's consistently had a really nice, I mean, even today's low, 7 to 14% earnings yield based on that method. You can look at tangible book value per share, the Shiller PE, the Ford rate of return. I mean, lots and lots of valuation metrics all inside of here that you can plot a chart format. It's just something I haven't seen anywhere else. I think it's extremely, extremely valuable. Stephen asks, how do you know what parameters drive which stocks? Stephen, to give you the honest truth, use these charts. I mean, look, 8 out of 10 stocks are going to be based primarily on earnings, right? I mean, that's primarily what it is. They're valued based on forward expectations of what those earnings are going to be. But, you know, if you're a deep discount value investor and you're just looking for stocks trading below book, you may want to use that. If you like the retail sector, I would definitely encourage you just to overlay some sales figures on this chart when looking at retail stocks, because that you may get another piece of the puzzle through that as well. Now, there are also prefab charts here. Okay, so one of the easiest ways to start with this, up in the top, if you can see this, is you see this where it says predefined chart right here above the blue chart, right below where you enter the new ticker symbol. It says predefined chart, and there's this drop-down menu. So if we drop down this menu, there are several already in here. Okay, one is the Peter Lynch chart. This one is fairly simple. It's one of the most popular as well. It is simply the price of the stock at a PE of 15. We've been looking at this a lot. Okay, and it includes the analyst expectations as well. Another is those price to sales valuation bands we mentioned. So it's going to show you the high and the low end, and you can add the median as well if you want, but you'll get a pretty good idea of where you lie within that price to sales range, the historical price to sales range. Another is just depicting the entire income statement or balance sheet. So everything on the income statement, revenue, earnings before interest and taxes, net income, gross profit, is all depicted here. Now, you don't have to try to connect the dots and make anything pretty, but you know, if you're just looking at the big picture fundamentals of a company and you want to see, hey, is revenue growing, is income growing, is there profit growing? I mean, these are clean, solid fundamentals, right? Versus, let's compare this to like a BlackBerry income statement, and that is not quite as pretty, right? I mean, we've seen nothing but declines for the most part for the last 4 years. This is bad trend. This is how stocks go from 140 to 5, you know. So that's a nice depiction there as well. Some people are more visual, some are more numbers driven. It just depends on how you want to see that data. But for you visual guys, a lot of this is going to be helpful. Do the same thing with a balance sheet. A big picture indication here, this is the gross domestic product, gross national product, if you just want to see kind of where we lie there. The dividend yield of the market can be plotted. Eventually, it's hanging up on me. This is the price versus the revenue of the company. Another thing you can do is save your own charts, right? So if there's certain parameters, like let's say, you're looking at retails and you want to see the earnings history, you want to see the price to sales bands, and you want to see, book value or something. Once you kind of get this set up how you want it, you've got whatever indicators you want to see. You can name the charts. Let's just name it, retail, for example. Click Save Settings, and you see here your setting is saved successfully. So what does that mean now? Well, now we can put any stock in here, and at any time, now it's one of our user-defined charts listed right there. So you don't have to go through, dig through each of these fundamental indicators and put them back on your chart. You know you've got one you like to use for retail stocks. You know you got one you like to use for bargain stocks. You know you got one for growth or international, whatever that may be. Now, someone asked about comparing a stock to the industry in general. What you can do is, if you're plotting, let's go to a company one of y'all might actually be holding. Let's look at like a General Electric, for example. If we're looking at, say, the price to sales ratio, we can check this box. If you can see this above the chart, right next to that Save Settings, it says Industry Median. If you check that, it'll lay the industry median of that indicator as well. So, we've got the GE price to sales ratio in red, and it's 1.8. Here in this light blue, for the industrial product sector, their median price to sales ratio, as you can see here, is just under 1. All right, so that's one way to overlay the industry with one of those technical, the fundamental analytics you're looking at. So a couple more things I want to show you, and let's look big picture. Now, this is something Charlie, the owner here at GuruFocus, showed me. You can do a couple of things. I mean, we know that one of Buffett's favorite is the gross domestic product versus, let's see, how does he set this up? Oh, here it is. The ratio of the Wilshire 5000 over GNP. And let me remove the GE stuff. So down here at the bottom under economic indicators, one of them is the ratio of the Wilshire 5000 over GNP. And so Warren Buffett's talked a lot about it. Basically, it's the gross national product or gross domestic product versus the market cap of the entire market. Okay, and so Buffett says anytime the market cap of the domestic stocks is greater than the gross domestic product, it's a bit of a danger zone for him to buy. Now, obviously, right now we're very high. The market is still strong, but he kind of likes to look for it. Less than 0.8 is an opportune time to buy stocks. Above 1 is kind of a more dangerous time. So that's one thing you can look at here. Another is this one right here, the Chicago Fed National Financial Conditions Leverage Subindex. It's a mouthful. But essentially, what this shows us is the looseness or tightness of money flow in the U.S. capital markets. Now, 0 is kind of a baseline, so anything below 0 is said to be loose. Anything above zero is said to be kind of tighter money conditions. And we've heard this on CNBC, right? I mean, money's loose, capital's easy to get access to, or money's tight, lending's tough. When we look at this, it's done a pretty good job of kind of forecasting dangerous and opportune times. So if we look at the last couple of crashes, let's go here. The peak of this was November 2008. Coincidentally, the peak of the market before the big depression of 08 and 09, right? So as this got really, really tight, I mean, the highest we've seen it since 1975, when money gets that tight, equity markets tend to go into a crash. The same thing happened here in 99, right before the tech bubble crash of 2000. It got up here over one, money got really, really tight, and we crashed back. Same thing happened here in the early 80s before the bear market there, the mid to late 80s. So on the other side of the coin, when money gets really, really loose, it tends to fuel markets. I mean, the low here after the tech bubble boost, this is one of the greatest times you could have invested here in 2009 as this money got extremely loose, great time to invest. And a lot of people that are calling for a market pullback, Charlie, the owner here at the company, has looked to this a lot and has kind of said, look, until the money flow tightens up, as long as there's this much excess capital out there that people are going to take on risk with, it's difficult to see. I don't want to say it's difficult to see a pullback, but very difficult to see a heavy market crash. So definitely a good indicator. Keep this, add this to your wheelhouse. Use this as a tool to look for times when the market may be getting overinflated. It's time to take some risk off, lighten up your equity positions, maybe hold up a little bit higher cash. Scott asks, if you use PE as an example, does GuruFocus use the real price versus the last available quarter result? Yes, it does. Yeah, use the trailing 12 months, right? So Kendra asks, how do you factor in the unprecedented Fed moves in the last 2 years versus historical data? And Kendra, Kendra, it's a good point. What we've seen in the last 5 to 6 years is really an unprecedented time in the financial market. So that's why we're seeing some of these traditional indicators that tend to tell us when markets are overcooked or undercooked get pretty inflated because we continue to have really, really loose money and really, really low interest rates. But this is a really interesting one, so keep that in mind. Chicago Fed, National Financial Conditions Leveraged Subindex. It's one of these down here in the economic indicators. But there's a lot of others, right? I mean, if we're looking for bubble and collapse indications, we've got the use of margin. We've got we can look at what corporate profit margins have been historically and where they stand today in comparison to that. We can look at the investor margin debt. We see margins finally beginning to pull back here. The B of A Merrill Lynch U.S. high yield levels. There are all kinds of international data here. So you can even chart the total U.S. population, the savings rate, government employees, all the international exchange rates, consumer price index, corporate profit levels, federal stimulus packages. This you could seriously spend a week in here. So not all this data. We like to kind of give you more than you need, just in case you want to play with it, but you probably won't need all this data, but it is all there. Anything that comes from the direct Bloomberg data feed is powering the site. You do have access to it as a member of GuruFocus. So Russell asked, what are some options for a new user to learn GuruFocus? And Russell, what I would do for you, stick to some of these predefined ones. I believe there is an area that has, I would use the chart and also start with the, I'm looking for it. The screener, here it is, the all-in-one screener, because the screener is a nice way to kind of put some stocks on your radar that may be worth going after. And there's a couple of predetermined, pre-filled screens here. There's the Ben Graham formula, the Joel Greenblatt's magic formula, the top 10 stocks bought by hedge funds, the Peter Lynch screen. So these are some really, tried and tested screeners that will allow you to find a set of stocks and begin kind of digging into them. Now, there's also a couple of smaller options here in the top. And we're looking at annual data. If you want to look at quarterly data to fine-tune this a little better, you can do that as well. If you want to look at this in logarithmic form, you can click that box there. If you like kind of the old traditional style of charts, you can definitely do that. If you want to highlight the U.S. recession, that's also a nice way to look at this, because one of the things we mentioned was that Chicago Fed National Financials Leverage Indicator. I apologize, my computer's a little slow broadcasting here, but as we see, when we highlight these, most of the time when we had too tight of funds, it led to these little mini recessions. So you can also keep this in mind for the stock, right? I mean, if you want to look, let's say we're looking at Procter and Gamble. Let's just say we're going to look at one of our predefined charts. Let's say we're going to look at a Peter Lynch chart, for instance, which is going to show us, when is a decent time to buy this stock. By checking on this U.S. recession box, it's going to highlight, oh, well, this, if the data looks funny, there's a big blip in it, that's why we were in a recession at that time. So Frank asks, I'm new to this. How can this be helpful to someone who just started to invest? Frank, start with the basics. One's going to be this Peter Lynch chart here. When you're looking at any large cap, blue chip, salt of the earth, been around paying dividends for 30 years type company, this Peter Lynch chart is invaluable. It's going to give you a line at a PE of 15. What you can do is figure what the earnings multiple is of the market, put that in, and you'll quickly see if we're trading below the market levels or above. Okay, that's one thing you can do. Another, especially with the retailers, I really like these price to sales valuation bands. It gives us a really nice idea of the range these stocks should be trading in based on historical valuations, and kind of are we near the higher end of the historic valuation levels, or are we near the lower end? And I like to come in here and add the median price to sales too, just to give us a kind of better idea. Now, one tip for some of you who are looking at companies, things look too good to be true, look at the number of outstanding shares. This is one of the reasons Procter & Gamble has generated such great returns. They've been buying back shares since 2008, and we see it's gone from 3.3 billion down to 2.9, kind of a carnivore company, right? It's gobbling up its shares, it's concentrating your holdings and making it worth that much more. It's always a good sign when we're looking at a long-term hold. In addition, if you don't want to look at price, just percentage change, you can check that box as well. In all these options, it's really, really formidable. There are some articles below the chart. Kind of go over the Peter Lynch chart, how to construct them, new features to the interactive charts, how to draw your own customized series, an interactive tutorial. This one will probably be there in a few days. So, dig in, take your time. If you feel overwhelmed after seeing this webinar, it was not the purpose. It is always better to know you have more tools and more professional data than you will need than saying, oh man, I wish I had access to that, right? So you may only use 4 or 5 of these things in the most popular list ever. But sometime you're going to get bored, and it's nice to kind of understand the rest of this and dig into it. So what questions do we have? Anyone have anything we need to cover on this webinar before we let you go? I apologize, it ran a little bit long. We wanted to get in here and show you the full capabilities of this, and believe it or not, we've only touched on a portion of it. But the more advanced you become, or the more advanced of a money manager or investor you are, obviously the more of this you'll want to use in your own practice. Intrinsic value using the Ben Graham formula. Let's see if that's in here. Here it is. Under valuation and quality, there is a gram number. And apparently for Procter & Gamble, that number is 0. Let's look at another stock. Let's look at General Motors. And there it is there. So what this is going to do, Craig, is give you that gram number, which is based on Graham's formula, his intrinsic value figure for that stock. So really, really nice little feature there. Chris, what would you suggest to look at for biotechs? Chris, that's a tough one. I mean, biotechs are so, $2 one day, $20 the next. I don't really know. It's not a specialty of mine. I guarantee whatever it is you're going to look at, it's going to be in here. I would definitely look at sales, though, as one of those things, or the total revenue, right? I mean, you want to see them selling something and growing. All right, Dr. Adam, you asked about the PEG ratio. One thing we can do is create your own customized series. Okay, so if we
do a P ratio over EPS growth.
If we click on customized series,
P divided by E. P divided by E. Sorry. P.
What we can do is build our own. So we're going to put our PE ratio divided by
EPS.
Earnings per share, year-over-year earnings per share growth. We're going to name this the PEG ratio. Put it on option 2. Finish this up. And let me see where it is. Go down to our customized series, select our new PEG.
This company may not have it because its history too short. Go to like Johnson Johnson.
Let's look at that. And it will plot it on there. Now we're not seeing it for General Motors because there's not enough history. If we look at like a Johnson & Johnson though, we've got our new customized PEG indicator on there. It should project this out for us. I'll have to look. I might have done that wrong, but that's kind of what you're going to want to do, is just kind of build your own. It may be something added later on. Michael asks, there's some major differences between GuruFocus and FinViz. Yeah, FinViz is got a decent screener if you're a technical analyst, meaning you like to, when the red line crosses the green line, jump on the purple line. It's all about moving averages and momentums and things like that. The GuruFocus, I mean, it's the same concept, the same screener. If you're a technician, that's where you're going to want to be. If you're a value investor, you're a traditional stock investor, and you want to look at the actual numbers, GuruFocus is the only screener and charting capabilities I've ever seen that can plot and scan through this many securities with all these fundamental data points. Michael, anything here to find something short-term to use with weekly options? I mean, you can use any derivative you choose in order to profit from this. When you're looking at a weekly basis, I mean, that's really kind of whim of the market, right? If you knew how much your weekly option broker made, you'd probably stop trading them. But no, I mean, look, if you find an opportunity, for instance, with Amazon, I mean, I bought a couple of calls in this stock because, look, Amazon has been a really consistent player that has been glued to the 2 times sales level. And when I saw the thing trading this far below that in the 300s, I did buy some call options on it. Now, did I buy a weekly call option? No, simply because, I mean, I can't tell you what the stock price is going to do over the next week. Honestly, no one can. If they tell you they can, they're lying. I mean, you may want to look, 3 months out, 6 months out, a year out, look at some leaps, something like that. But as far as weekly options, I'm afraid you're kind of on your own there. Okay, Henry, will do. Somebody asked if there's a value investing letter I recommend. There was a really good one, Buffett, you just subscribed to that no longer exists. Honestly, though, the best research I've found is here on the website. Many of our members are multi-billion-dollar fund managers, and I'm not making this up. I mean, I'm not going to throw names out here, but there are some monster investors who use GuruFocus for their data. So a lot of people contribute to the site and 2 articles in here, and there's a lot. You'll see you'll get like the member emails once a week, twice a week with kind of some highlighted articles, but just off the home page, some of these editors' picks are the latest articles. Look at ones that have seen a lot of reads. You'll find some really great ideas just kind of digging through this, and people will kind of make a case for their stock, and they've kind of done all the research for you, and you kind of either agree or you don't. The other great place is just some of the screeners here. I mean, some of these screeners have outperformed consistently. Here, the low price to book strategy has been beating it. The Buffett Munger has been beating it. The undervalued stock screener has been really slaughtering it. Low price to sales has been beating it. And you can kind of learn more about these. They're all free to you as a member. If you click on the compare all strategies, it'll show you exactly what they've done on an annual basis and since inception. And you can just click on the link to these. This one's, for instance, outperformed the S&P by 45%. Click on that. Here's the screener. Here's the stocks. You can sort it by country, by market cap, by sector, and it's going to give you some really, really good stocks to start looking at. Michael, what is free and what is fee? I honestly don't know. I mean, I've been a member for so long, I kind of forget what's not. I think you can. Basically, if you're not a member, just click around. If it won't let you go there, it's a paid feature. What's the membership now, Charlie? $249. $349 for US. Yeah, I mean it is well worth the money. It's the best data, research, and analytical tools you'll find anywhere on the market. So if you were even an amateur investor, I would strongly encourage you to become a member. Obviously, I'm sitting in the GuruFocus office, so I'm biased, but I can say without a doubt this is the best research I've seen anywhere for value investors. All right, well, if there's no other questions, we'll go ahead and end the webinar. We appreciate you all joining us here. We will get this recording up and shot out to you guys via email, and you should see it on the site within the next week or so. We appreciate you coming. We'll do another one next week. If you have recommendations on what you'd like to see covered, if there are features of the website you don't fully understand, if there are areas that you'd like to see dug in a little bit deeper, please feel free to shoot us an email. Just send it to Charlie at GuruFocus.com. You're sending an email directly to the owner of the company and the main programmer here, and we will be sure to address those for you guys in the future. Thanks again for coming, and we look forward to seeing you guys next week.